Hi students, okay, we will be focusing chapter 20.2, week 2, lesson 1, okay, and you have my contact details on the PowerPoint slide. Please check, and whatever work that you have done, please email to me. Alright, okay, let's look at the instruction slide. Okay, you have the instruction there. Students are required to do the following. Okay, first thing, read Business Studies Course Book, Chapter 20, page 263 till page 265, and I have attached some notes. Please go through. Okay, watch. There's two video link, YouTube video link. Please go through. Alright, this is on working capital. And do these questions. Please do it in your exercise book or foolscap paper, and take clear picture of your answers. And email to me, okay, by 22nd of April 2020. Okay, there's 3 tasks given. Test yourself, page 264. Task on case study, page 263, and task for case study 265. Alright, now let's go through outcome. Yeah. Okay, now the first learning outcome, the importance of cash to businesses. Yeah, the management of cash is very important to manage it as well, to a business, because it must have enough cash coming in to cover the cash leaving the business. Okay, the second thing we learned is on the cash flow forecasting. Okay, because it shows the forecasted cash inflows and cash outflows, and then you have the net cash flow. Remember the formula: cash inflow minus cash outflow. Then help managers plan ahead. Okay, this is the main reason you need your forecast. Okay, then you can arrange your loans. If negative cash flow is forecasted, you can use overdraft, bank overdraft. Then can forecast likely level to overdraft required. And new businesses will need to provide one to obtain bank finance. Okay, all this can be done. All right, next one, how business deal with short term cash flow problem. Okay, like for example, cash flow short term problem. Okay, they can increase their bank loans. Okay, how it works, they can take some money from the loan, okay, and then they can actually put in into their business. Okay, they can invest back, buy material and so on, or they can delay payment to supplier. So this how it works, cash outflow will decrease in short term. Okay, or they can ask debtors to pay more quickly, or insisting on only cash sales, that means pay cash. So cash inflow will increase in the short term, so they can see more positive than negative cash flow. Okay, they can also delay or cancel purchases of capital equipment, which is not so important for time being. So cash outflow for purchase of equipment will decrease. Okay, this is the way that they can do. So today we will be focusing on the importance of working capital to businesses. Okay, what is working capital about? Remember, working capital is running day to day expenses. Okay, whatever expenses is done day to day, okay, it's all under working capital. Let's go through the slide. Today we will be focusing on working capital. All right, look at the working capital cycle. Okay, this is in your textbook, page 264. All right, so what is working capital? Okay, working capital is the capital needed to finance the day to day running expenses and to pay short term debts of the business, of a business. So the capital needed to finance the day-to-day running expenses and pay short-term debts of a business. Okay, there are 4 components in the working capital cycle. You have cash, inventory purchased on credit, then you have production of goods for sale, goods sold to customers on credit. Okay, all this is actually uh, you have enough money to pay finance to pay for their day-to-day expenses, such as paying workers capital and buying raw material. Okay, many businesses offer their customers credit terms, so they must also be able to finance the level of credit given to these customers. Working capital measures the liquidity of a business. Now, liquidity is the ability of a business to pay its short term debts. So a business which does not have enough money, working capital, will be illiquid. Okay, let's look at the next slide. Now, the length of working capital cycle depends on the level of inventory held by a business and how quickly suppliers are paid. Okay, so when the suppliers are paid, you will get the money, right? Okay, next point, how long it takes to produce goods for sale. Okay, how fast the business can send out for sale. Next one, how quickly the business finds buyer for its product. Okay, can they promote their product to buy? Okay, or they can get us a proper contract for the business to send their products every month. Okay, the length of the credit period customers are given credit sale, how long? All right, within 30 days and so on. Okay, next slide. A business can improve its working capital by reducing inventory level. Okay, they can try to reduce their inventory level. Either can go through lean production, like remember what we learned in chapter 15, okay, on production. All right, so they can reduce inventory level. Next one, negotiate longer credit terms with its supplier. So instead of 30 days, go for 40 days. Next one, reducing the amount of time it takes to receive payment from customers who have been supplied goods on credit terms. So reducing the amount of time, okay, so that you can negotiate with them longer. All right, so there are some equation here. Working capital is equals to current asset minus current liabilities. Okay, we will learn this later. Okay, just to go through quickly, although you will learn this in chapter 22 on working asset, just to get you to know what is working capital is. Okay, now working capital, current assets such as cash in hand and in bank money that you have. Account receivable is the amount owed to a company, resulting that from the company providing goods and or services on credit. So the unpaid balance in this account is reported as part of the current asset listed on the company's balance sheet. Next one is finished goods inventory. Okay, that whatever is goods is already finished and ready for sale or ready to send to the retailer. Then you have your raw material inventory, whereby okay, it's ready to produce for your production, and work in progress. Okay, that continually flows in and out of a firms during the course of its business cycle. Okay, also called circulating asset or floating asset. All right, this is not so important, but just to know. All right, getting into the next slide. Okay, current asset. A current asset is cash and any other company asset that will be turning to cash within 1 year from the date shown in the heading of the company's balance sheet. You can see current asset in the balance sheet. Okay. Okay, next slide on current liability. A current liability is an obligation that is due within 1 year. That means 1 year of the date of company's balance sheet will require the use of current asset or will create another current liability. Okay, if company's operating cycle is longer than 1 year, so current liabilities are those obligations due within the operating cycle. Don't worry, we will learn this more deeply in chapter 22. Alright, we had completed chapter 20. Okay, at the end of this lesson, okay, we have learned, okay, the importance of cash to a business. Okay, why? Because you have to pay employees wages, it's you need to pay for the supplier and services, and you have to pay for the rent, heating, your electric bill, and so on. Okay, you can refer back in your textbook, page 258. Second thing, what is meant by cash flow? Remember what is cash flow? Okay, you have cash flow forecast, then you have net cash flow, then you have cash in, cash out. Okay, outflow and inflow. You can refer this in page 259. Next one, number 3, the difference between the profit made by a business and its cash flow position. Okay, you can refer back this in page 259 and 260. Remember the sample of cash flow forecast? You can see what's the position like. If it's negative, then the business is not doing well for the month, but if it's a positive, then the business is doing very well. Okay, next one, how a business might improve its cash flow position. So like what I told you, there are 3 ways. What are those? Remember? can ask trade receivable to pay more for goods more quickly by offering good discounts to customers who have been sold goods on credit, or they can negotiate longer credit terms with supplier, or they can delay the purchase of non-current assets until the cash flow improves, or they can find other sources of finance for purchase of non-current assets. Okay, you can refer that in page 262. Okay. All right, next one, how a business might improve its cash flow position. Okay, there's some ways that they can do. They can delay or cancel purchases of capital equipment. That's basically about, because if they wanted to buy the vehicle, okay, it's more to cash outflow. So what they can do to temporarily, um, you know, to get back their money. Okay, that means to show it more positive, then they can delay or cancel purchase of capital equipment. All right, that is in page that is the figure 20.3. All right, last one, number 6. Okay, number 6, what is working capital and why it is important to a business? Okay, like what I told you, working capital is basically uh, measures the liquidity of a business. So liquidity is the ability of a business to pay its short-term debts. A business which does not have enough working capital, then it will be illiquid. That means they can't pay. Right? So that means they cannot pay, and it's just their short-term debts. They can't even pay their short-term debts. Then how they can pay their loans and so on. So if this happens, the business may have to borrow the finance required. So again, money going out. So however, if the business is unable to borrow the finance, then they require finance. They have to pay. Okay, then the business might fail. So this will be even more problem for the business. Okay, that's it for today. Okay, later please go through the instruction slides, okay, which I had mentioned earlier. Okay, please clear your doubts or any questions, please refer back to me. I can guide you. Okay, you can WhatsApp me or email it to me. All right, so we will discuss what to do next. All right, see you, have a great day. Bye bye.